For most people, money feels digital. Numbers on a screen. Balances that move without weight or sound. But beneath that surface exists a system so powerful, so normalized, that it rarely gets questioned. A system that has shaped wars, alliances, and entire economies for over 50 years. It revolves around a simple idea: oil, and the currency used to buy it. This is the story of the petrodollar, and why that system is no longer as permanent as it once seemed. The petrodollar is not a physical bill. It is not written into any global constitution. It is an agreement without a single signature. A structure built on incentives, dependencies, and power. For decades, it quietly decided which currency ruled the world. To understand why its influence is now weakening, we need to return to a moment when the global financial order nearly collapsed. Early 1970s. The US dollar was still officially tied to gold. But behind the scenes, that promise was already broken. Years of war spending, trade deficits, and global expansion had drained America's gold reserves. Foreign governments were demanding conversion. The math no longer worked. In 1971, the United States made a historic decision. It ended the gold standard. Overnight, the dollar became fiat, backed not by metal, but by confidence. And confidence on its own is fragile. At the same time, another force was becoming unavoidable: oil. Modern economies didn't just use oil. They depended on it. Transportation, industry, electricity, military power. Oil was no longer a commodity, it was infrastructure. So the question became simple: if gold could no longer anchor the dollar, what could? The answer wasn't announced publicly. It wasn't debated in global forums, it was negotiated quietly. The United States reached an understanding with major oil-producing nations, led by Saudi Arabia. Oil would be priced and sold exclusively in US dollars. In return, the United States would provide security, military protection, and access to its financial system. No dollar. No oil. This single rule changed everything. Every country that needed energy now needed dollars first. To get dollars, they had to export goods, borrow from dollar markets, or hold US debt. Global demand for the dollar became permanent. Not because people trusted it blindly, but because they had no alternative. The dollar stopped being just America's currency. It became the operating system of global trade, and for decades. The system worked, but stability can hide weakness. And systems built on dominance rarely fail suddenly. They erode. For a long time, the petrodollar looked unbreakable. Oil flowed, dollars circulated, and the global economy adjusted itself around that reality. Countries sold goods to earn dollars. Central banks stored those dollars as reserves. Excess cash flowed back into US Treasury bonds. This feedback loop did something remarkable. It allowed the United States to run persistent deficits. Without facing the same consequences other countries would. Debt increased. Spending expanded, yet demand for the dollar stayed strong. Not because the system was fair, but because it was efficient. As long as oil was priced in dollars, the world needed dollars. And as long as the world needed dollars, the system reinforced itself. But every system like this rests on assumptions. That the United States would remain the dominant military power. That oil exporters would see alignment with Washington as their safest option. That no rival settlement system could scale. And that access to the dollar would remain politically neutral. Over time, each of those assumptions began to weaken. The first cracks did not appear in markets. They appeared in foreign policy. As sanctions became a preferred tool of pressure, something subtle changed. The dollar stopped feeling neutral. Access to payment systems could be restricted. Reserves could be frozen. Entire economies could be cut off with legal notices instead of armies. For Washington, this was leverage. For everyone else, it was a warning. If dollars could be blocked, then holding dollars carried risk. At first, the response was quiet. Countries didn't abandon the system. They hedged. Gold reserves increased. Local currency trade agreements appeared. Small bilateral deals bypassed dollar clearing. Nothing dramatic. Nothing headline-worthy. But incentives were shifting. Then came moments that made those risks impossible to ignore. When reserves were frozen during geopolitical conflicts, the message spread far beyond the countries involved. Your money is only yours as long as the system allows it to be used. For governments responsible for national stability, that realization mattered. The petrodollar had always been about trust. Not trust in oil, not trust in America. Trust in access. And once access feels conditional, Dependence becomes dangerous. This didn't trigger an exit. It triggered planning. Because global systems don't collapse when people panic. They change when people prepare. And quietly, preparation was underway. The shift accelerated when global power itself began to rebalance. China's rise changed the equation. It became the world's largest manufacturer, the largest trading nation, and eventually the largest importer of energy. Yet every major energy purchase still depended on a system it did not control. For Beijing, this wasn't ideological, it was structural. If energy is settled in a foreign currency, then energy security is partially outsourced. So China didn't challenge the system directly. It built alternatives alongside it. Currency swap lines with trading partners. New payment infrastructure outside traditional dollar channels. Energy contracts settled in yuan instead of dollars. Not to replace the dollar overnight, but to reduce exposure. Russia moved faster. Years of sanctions had already limited its access to dollar markets. Energy exports were rerouted. Settlements shifted to non-dollar currencies. Reserves were diversified. Then came a turning point. When a portion of Russia's foreign reserves was frozen, a long-standing fear became reality. For many governments watching, the lesson was clear. Reserves are not just financial assets. They are political instruments. From that moment, diversification stopped being theoretical. It became defensive policy. Even countries aligned with the United States took notice. Not because they expected conflict, but because systems based on trust must account for worst-case scenarios. At the same time, the energy world itself was changing. Oil was still essential, but it was no longer the only pillar. Natural gas markets fragmented. Renewables scaled faster than expected. Electrification reduced long-term oil demand growth. Energy security began to mean diversity, not dependence. And a diversified energy world doesn't naturally support a single settlement currency. As contracts multiplied and trade routes shifted, flexibility became valuable. Some oil deals introduced currency options. Others used regional settlement arrangements. None of this ended the petrodollar, but it weakened its exclusivity. And exclusivity is what turns a currency into an anchor. What was once automatic became optional. Not everywhere, not all at once, but enough to change the direction of the system. Pressure was also building from inside the United States. Reserve currency status comes with privilege, but it also comes with responsibility. For decades, global demand for dollars absorbed America's deficits. Foreign savings flowed into U.S. assets. Interest rates stayed lower than they otherwise would have. But this arrangement depends on confidence, not perfection. Confidence. As U.S. debt levels climbed and political polarization deepened, that confidence became more conditional. Debt itself wasn't the problem. Reserve currency issuers can sustain high debt. The issue was predictability. Repeated debt ceiling standoffs. Fiscal gridlock. The growing risk of self-inflicted instability. For foreign reserve managers, the question slowly changed. Not, is the dollar collapsing? But, is it wise to be this concentrated? So they adjusted. No panic selling. No sudden exits. Just gradual rebalancing. A slightly higher share of gold. A slightly lower share of treasuries. More regional currencies and reserves. Individually, these moves looked insignificant. Collectively, they mattered. Because the petrodollar system doesn't rely on dominance alone. It relies on inelastic demand. When demand becomes flexible, even at the margins, the system behaves differently. Borrowing costs respond faster. Policy mistakes carry clearer consequences. External discipline increases. This doesn't weaken the dollar immediately. It changes the environment it operates in. And that environment was becoming less forgiving. The privilege of issuing the world's settlement currency was no longer invisible. It was being priced, quietly. For oil-producing nations, the logic was changing too. For decades, pricing oil in dollars offered clear advantages. Deep financial markets, stable demand, political protection. But as global power diversified, so did leverage. Producers were no longer selling to a single dominant buyer. They were balancing relationships. The United States, China, Europe, regional partners. In that environment, flexibility mattered. Pricing oil in only one currency limited options. Allowing alternatives increased bargaining power. This didn't mean rejecting the dollar. It meant reducing dependency. When major producers signaled openness to non-dollar settlements, the message was subtle but important. Optionality. The ability to transact across systems without full commitment to any single one. And optionality undermines monopoly structures. Because the petrodollar was never enforced by law. It was enforced by convenience. Once convenience becomes negotiable, dominance fades. There was also a deeper contradiction emerging. The dollar-based system gave the United States extraordinary influence. But using that influence too aggressively encouraged fragmentation. Every financial restriction solved a short-term problem and created a long-term incentive to build alternatives. Not because countries wanted confrontation, but because resilience requires redundancy. This is the paradox at the center of the system. Use power and weaken the structure. Restrain power and lose leverage. There is no stable equilibrium, only trade-offs. And as more actors optimized for flexibility instead of loyalty, the system adjusted, not through collapse, through slow decentralization, layer by layer. You've probably heard people talking about the fall of the petrodollar, but that phrase is pretty misleading. What's really happening isn't a collapse, it's a dilution. Let's break it down. The US dollar still dominates global trade. Most oil is priced in dollars, and most international reserves are still held in dollars. But here's the key, that dominance is no longer absolute. And it was that absolute power that made the system so strong and self-reinforcing. Today, we're seeing energy trade become multi-currency. Countries are diversifying their reserves away from just the dollar. And payment systems are becoming more fragmented. This isn't because some new supercurrency has come along to replace the dollar. It's because many smaller, partial alternatives now exist. Now, none of these alternatives are as liquid or as trusted as the dollar. But when you add them all together, they start to change the game. The result is a global financial system that's a little less efficient, but also a little more resilient. For the United States, this shift means borrowing costs could become more sensitive, and there will be clearer limits on fiscal policy. The margin for error is getting smaller, not overnight, but gradually. For other countries, relying less on the dollar offers some protection from U.S. policy, but it also brings new challenges like managing exchange rate risks and higher hedging costs. The old system was simple but fragile. This emerging system is messy, but it has backups. Historically, this kind of transition is normal. Reserve currencies rarely just vanish. They lose their exclusive status first. The British pound didn't just collapse when the dollar rose. It slowly stepped back as the world's economic center of gravity shifted. What makes this moment different is the sheer speed of change. Technology lets everyone adapt faster, finance moves at the speed of light, and information spreads instantly. So, adjustments that used to take generations are now happening in just a few years, and that's changing how power erodes. It's not happening with a big bang, but with the quiet arrival of new options. Thanks for watching. If you found this interesting, make sure to like and subscribe for more insights.